Look at the Fear and Greed Index. It sits at a stubborn neutral, while retail sentiment remains paralyzed by minor corrections. But beneath the surface, something unprecedented is happening. We are witnessing the institutional siphon. While you watch the 1-minute candles, BlackRock, Fidelity, and the new wave of XRP ETF issuers are executing systematic buy orders. They aren't trading, they are harvesting. This divergence is the most important macro signal of the decade. Institutional capital doesn't enter the market like a retail FOMO buy. It operates through systematic investment plans or SIP-based algorithms. This creates a perpetual buy-side pressure that absorbs volatility. Since the launch of the Bitcoin spot ETFs, we've seen net inflows exceed billions during price tips. This is why the crash everyone is waiting for never seems to hit the bottom retail expects. The floor isn't made of retail hope, it's made of corporate balance sheets.
Let's talk levels. Bitcoin is currently testing the $68,000 to $70,000 range. For the casual observer, this is just price action. For the institutional desk, this is a value area high support flip. On the weekly time frame, holding $68,000 confirms that the previous resistance has successfully transitioned into a structural liquidity floor. If the bulls defend this zone, we aren't just looking at a rally, we're looking at a launch pad for the next leg towards 6 figures.
Analyzing the volume profile visible range, VPVR, we see a massive liquidity gap below 60K, which institutions are desperate to prevent us from entering. They are front-running the gap. By layering orders between 68K and 70K, they are essentially painting the tape. This technical fortification suggests that the market is being structurally re-engineered to prevent the 80% drawdowns of previous cycles. While Bitcoin leads, Ethereum is fighting a different battle. All eyes are on the $2,046 recovery level. This isn't an arbitrary number. It's the historical point of control for the post-merge era. Ethereum's institutional narrative has shifted from ultrasound money to the world's settlement layer. As institutional ETFs begin to eye ETH, the move back toward $2,046 represents the first step in reclaiming its dominance against the rising altcoin tide. Now look further ahead. Solana is preparing for the Alpenglow Upgrade, a massive consensus overhaul targeted for the second half of 2026. While the market focuses on today's outages or TPS counts, Alpenglow aims to achieve asynchronous execution at a global scale. This isn't just an update, it's a total re-architecture of how blockchains handle state. If successful, Alpenglow could make Solana the definitive high-frequency trading floor for the entire world. Why does a 2026 upgrade matter now? Because institutional money front-runs tech cycles by 18 to 24 months. The accumulation we see in Sol today is a direct bet on the Alpenglow architecture. As Ethereum struggles with L2 fragmentation, Solana's monolithic approach, combined with Alpenglow's efficiency, could solve the blockchain trilemma once and for all. This is the killer catalyst that most retail traders are ignoring because it's too far away.
In a world of institutional siphoning, not all assets are created equal. When ranking the top 10 by market cap for stable long-term growth, Bitcoin and Ethereum remain the reserve assets. However, the real alpha is shifting. We rank Solana and XRP as the primary utility plays due to their legal clarity and infrastructure focus. BNB and Cardano represent ecosystem plays, while the rest of the top 10 are increasingly treated as speculative hedges.
A professional portfolio in this era isn't about picking the next 100x meme coin. It's about following the siphon. We recommend a core satellite approach. 60% in the institutional floor assets, BTC/ETH, 30% in infrastructure leaders, Sol/XRP, and 10% in emerging tech. This mirrors the way family offices are now allocating to the space, prioritizing survival and compounding over raw leverage. Don't ignore the XRP ETF filings. XRP represents the bridge between traditional banking's ISO 2022 standards and the new decentralized economy. The institutional siphon isn't just taking money out of banks, it's using tokens like XRP to rewire how banks move value.
This creates a permanent liquidity floor for XRP that is independent of retail speculation.
But remember, institutions are not your friends. They provide a floor, but they also hunt for liquidity. They will use stop runs below $68,000 to shake out leveraged retail before the next move up. To survive the siphon, you must trade with the same time horizon they do. If you aren't looking at the 2026 Alpenglow horizon, you're playing a game you're designed to lose.
The divergence is clear. Retail is scared, but the money that moves markets is moving in. From Bitcoin's 68K support to Solana's Alpenglow future, the structural transformation of finance is happening now. You can either watch the volatility or follow the siphon. The question is, are you positioned for the floor, or are you waiting for a crash that might never come? Subscribe for more deep dives into the macro flow.